You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. All right, guys, welcome to another episode of Lender Lounge with yours truly, Kevin Kim. We are here with another special guest, Renee Lewis with Bloomfield Capital. Renee's coming to us live from Maine, right, Renee? You're up in Maine right now, right?
Correct. Portland, Maine.
And so to get us started, tell us a little bit about yourself and about Bloomfield Capital, and we'll go from there.
Sure. So I'm Renee Lewis, and I'm one of the partners at Bloomfield Capital. I've been in the business for a long time, working for a variety of funds. I started my career on the investment side and quickly found that due diligence was an interesting field that allowed me to combine my interest in real estate along with analytics, and I became one of the sort of early people practicing due diligence and underwriting. So I got my teeth sharpened underwriting large loan portfolios back in the 90s and through the 2000s. I've been with a couple of independent, flexible, fast-moving fund managers over the years, as well as working with some of the larger institutions. And I really enjoy working in the smaller loan space, which is where Bloomfield lives. We're commercial real estate, primarily lenders, bridge lenders in the $2 to $20 million loan size. And we find that it's interesting and fun. It's an area that has a little bit less competition than some of the really, really large loan sizes. And we are able to find transactions and make the returns that our investors would like in that space.
Fantastic. And for those of you guys, listeners who don't know, Bloomfield is like one of the larger, I would consider, like CRE bridge shops in the country. And you guys are pretty much in most markets now, right? You guys are how many markets now?
We're in almost 40 states.
Fantastic.
With transactions.
And you have offices in, I know you're in Maine, but
I'm in Maine. Headquarters is in outside of Detroit, and we have offices in New York, Los Angeles, Chicago, and Denver.
Fantastic. So there you go. Country, nationwide access. Good choice of headquarters. My family's originally from Detroit, so
yeah, that must be why we're there.
And when it comes to commercial bridge, a lot of our listeners either dabble or have done it in the past, and lately in the private lending sector, a lot of our clients have shifted their attention to residential because it's so hot. And I wanted to make sure we brought you on, Renee, because commercial real estate at this point in time in 2021, it's August right now, this will kind of air probably in September or October, is in a transitionary time right now, right? We're kind of in a post-COVID world, right? Tell us about kind of Bloomfield's approach when it comes to basically the primary food groups you guys lend on first, because you guys are pretty open-minded when it comes to asset class, but
right,
you have a very, very distinct mandate, because you specifically said you do loans from 2 to 20 million. You do commercial bridge, but talk about the specifics a little bit. So what type of asset classes are we typically lending on at Bloomfield?
And we're lending on a variety of asset types. So we will do residential, retail, office, industrial. We do not do a lot of land.
Mm-hmm.
We do not do a lot of ground up construction. We often will step into transactions that are partially completed, properties that are undergoing some sort of transition, change in use, lease up strategy. People might call us because there is a change in partnership, and and they need a new loan to help effectuate that capital requirement. It varies, but most of our deals are fairly complex. They're usually quite fast moving,
Mm-hmm.
and there's something that we have to solve for.
There's usually a specific non-financial issue that you're solving for as well, right?
Probably, yep, yeah. Right. Usually that is it, and so we are making sure that we understand the markets, the properties, the credit, the sponsorship. We dig deeply but quickly. We have a lot of experience on the team, which is helpful, and then structure accordingly. All of our deals, we don't use some form of document that's just to take it or leave it. All of these deals are unique and individual, and they need to be handled as such.
Right. And that seems to be kind of the story across the board when it comes to commercial bridge, especially, and transitionary loans and these types of this type of marketplace. And it was growing by leaps and bounds, from I would say from 17 to 20. Yeah. And then the COVID happened, and there were some adjustments that happened. But you guys weathered through last year's chaos, right? And I mean, I spoke with you privately about it. You said it really didn't affect you guys that much because you hadn't taken that much risk that we weren't comfortable with in your balance sheet play and stuff like that.
We felt pretty good with where our positions were, and we worked out what we needed to. Right. Again, I think with any bridge lender, you're in these assets or these positions for a short period of time. So there is never a time where you're originating something and sticking it on the shelf. We're always in contact with our borrowers and our sponsorship, and understanding what's going on and making sure that we're clear on what's happening with the business plan and that the properties are moving forward. So that's not so different than having to do a little bit of additional hand-holding.
Right. You're so entrenched with the borrower that this is just another day at the office, essentially.
Close to it, right?
And that raises another question for me is Bloomfield's. I mean, how long has Bloomfield been around now? You guys celebrated an anniversary recently, didn't you guys? Yeah,
we are 14.
14 years old,
I believe. Yeah,
fantastic.
I have to go.
Tell me a little bit about the story of the company. How long have you been with the company?
I've been with the company since 17. I had a firm that I merged with Bloomfield and became one of the partners.
Okay.
Bloomfield was founded originally by Nick Coburn. Jason Georgiosa joined him, as well as Brent Truscott. So the four of us are the partners of the company. We are a fund manager. We raise money and have our funds raised. We do not syndicate out our deals. We're not out raising money to close a transaction. We have several funds that we have raised, and then we utilize those for the opportunities that we see.
And unlike some of the other markets that we serve, like the resi space, we haven't seen as much disruption caused by Wall Street on the bridge side, at least on the origination front. But there's whispers of it happening. I mean, I'm hearing of essentially institutions taking on origination themselves, right? That seems to be the trend. What are you guys doing to make sure you're staying competitive and staying in front of those guys?
In front of larger banks and other.
I mean, not just the banks, but Wall Street type companies, right? And I'm hearing about hedge funds and asset managers who would normally just allocate capital, right, taking on an origination position themselves.
And we don't have a lot of capital from those groups. The money that we raise may be coming from pension funds, that sort of thing. And we don't co-invest with any hedge funds. We don't have.
So you're truly independent
like that. We are truly, fund managers, simply managing for the LPs.
Right. And has that been kind of like a temptation to combat over the years, right? Because, Wall Street jumped into the bridge sector as well, pretty heavily, probably, I would say about 4 to 5 years ago, maybe 6 years ago.
Right. Right. And everybody was levering up their portfolios and so
massively,
on.
right? And you started seeing securitizations happening and non-conforming securitizations, and it started becoming a very frothy marketplace. But risk was going to the roof too, right? So
that is correct. And so we maintained discipline during that period, which we're very thankful for. That there were other things to be sleepless over during COVID. That was not on our list.
That's fantastic. And tell me about is there like a decision-making process internally how do you guys combat those temptations? Because it's very easy for an operator to kind of like say, well, there's this massive opportunity for us to take this on. Is it past experience? Like what keeps you from
past experience? We are a very experienced group. I've been doing this for the better part of 30 years. My partners have been doing it for a long time as well. So, I think that we really try to keep our eyes open, and we try to be very communicative in every respect. The company, when you actually going back to, how do we operate during COVID, more communication internally, externally. We made sure that our team was understanding where we were. Everybody was on board, that we as a company and as lenders were very much, thinking about and talking about and making sure that it was understood where we were going and how we were able to grow and maintain during that period.
And you guys grew, right? You guys grew during 2020, right? And
bit, yeah. Not from a closed deal perspective. We watched the market. We didn't want, I think back to, we're very risk attuned. I think we wanted to make sure that we were understanding a little bit about, where the opportunities were. We thought that there might have been more of a distressed opportunity to jump into, which hasn't quite manifested itself the way that we had expected. And we were prepared for that. But, there was a lot of looking and testing, making sure that our portfolio was in good shape, and then getting back into the lending side.
Right. Well, and give us a little bit of an idea of like timeline wise, like a lot of folks say March, April was kind of the chaotic months, and then May or June was kind of when they kind of came out of it. But how about you guys?
Yeah, I think, that's probably, I don't know if it was chaotic, but we certainly were watching our positions again, because we were beholden only to ourselves. That was a nice spot to be. So it wasn't chaotic, but
we had reliable capital sources that you've built
so it was,
relationship with.
Right. So we were working with our sponsors and borrowers, through the summer. We did see some distressed opportunities that we jumped on.
Nice.
And so from an underwriting and closing standpoint, that kept us fresh. We tested out a couple of new ideas. But then I would say that by fall, we were back to originations, and it ended up being quite a good year. And then this year has already surpassed last year.
And tell me about that. I mean, so where are you seeing the growth verticals in 21?
It's been interesting. Been really there are some areas that we weren't seeing before. We've seen multifamily, which, for, the cost of our funds, we weren't seeing previously. We've seen industrial. We're doing a little bit more
Industrial's where there's on fire.
Yeah, industrial's on fire. We're seeing some deals. We're seeing opportunities where there is some relationship between the ownership of some level of owner occupancy. So that's
like single tenant stuff, or more like owner operator of one part of the property, or
might be both.
Okay,
it's happening in both, and we do have some mezzanine preferred equity and equity positions as well, and some of our equity is on the.
It's logical
side.
for to be. I mean, those opportunities are abound. Is there still a heavy appetite for the junior position stuff?
Sure, there is, because all of us in the industry have appetite for return also. So
it's mostly a yield-driven calculation.
It's a yield-driven calculation that gets mitigated by structure.
I hope you're enjoying this episode so far. I wanted to take a brief moment to tell you about Gerasi, the nation's largest law firm dedicated to the private lending industry. We have 3 legal departments vertically integrated to serve a private lender's business. We handle everything from licensing to new entity formation, fund formation, loan documents, national compliance, litigation, bankruptcy, foreclosure, and so much more. We pride ourselves on giving our clients the ultimate peace of mind. Check us out at jurasilawfirm.com. In addition, our internal conference line gives opportunities to you to network, learn from industry leaders, pitch to capital sources, and make new connections. Visit jurasicon.com for more information about our upcoming events. That's GERACICON.com. And let's talk about, multifamily, because that has been a topic on my mind a lot with, eviction moratoriums and various different policies that are coming out protecting tenants. We thought multifamily was going to be significantly at risk, right? But turns out not too bad. How about you? How do you guys feel about it? How did you guys feel about it back last year and going into now this year?
We looked hard at what was happening in terms of delinquency at the various properties that we had the opportunity to underwrite. And really, you all saw a lot of best-in-class operators coming up with creative solutions for their tenants. Mm-hmm. We wanted to see even more recently, are the operators finding the government programs? Are they helping their tenants if there are payment issues, to access those programs? Or what are they doing to make sure they're not just sitting passively and hoping for the best? Mm-hmm. But really trying to make sure that collection.
So you were looking beyond the financials once again, looking at the operator level and assessing their risk from that standpoint. And what did you see?
Because so much of what we do is about, can you effectuate the business plan? Mm-hmm. We can all write down what we would like to have happen,
right?
But we want to test as much as we can and make sure that we're understanding what the real plan is for the property. And
right, operationally speaking, what are you doing on a day-to-day basis as a sponsor?
Right.
That raises a question for you though. What were they doing that made you feel comfortable? Right? Were they doing like rent deferment plans? Were they doing? Were they getting other financing from like the government? Or what was something
it might have been rent deferment? I wanted to make sure they understood what their tenants really were up against. Were they actually doing door knocking, or were they, doing everything they could to understand where their particular tenants were? What were they doing to ensure, for new tenants that they were really understanding where they were working, that sort of thing? What were they doing to make sure that programs that were available were being accessed by their tenants?
Were you helping them in those situations for the ones that didn't understand it that well?
We are lenders. We're not the equity partner, but we can certainly note that, we're observing and seeing that the state of Ohio has an X, the state of Illinois has a Y, right. And ask if what do you think of those and what are you doing about it? And so sometimes that would be helpful in general. To the management company.
So I want to ask you about industrial now, because industrial it is on fire, right? And I mean my clients my builder clients can't get enough of it, right? They can't find it. They want it, they can't find it.
Yeah.
And they're building more of it. We have a couple clients that build industrial, and the interesting part of it is it's being used for multiple business types. And I mean, but the analysis changes from an MSA standpoint, right? Because you're not building mass industrial like in California here. You're not building it in the suburbs. You're building it in an area that's meant for industrial, right? And then how does that change your underwriting when you're looking at new, locales that may not necessarily be ideal from a lending standpoint?
Well, I think one of the important things in underwriting is to let the market talk to you and make sure that you're talking. When we are in 40 states, but it is important. It is critically important that we don't rely on mass data. My team speaks with people in every market. We try to understand the importance of that corner, that location, that right turn in, that whatever it might be, and that sub-market, and then the market, and then the MSA. So you want to make sure that what you're doing is investing in a property that's appropriate, and therefore the business plan is logical and can succeed.
Going
So
back to beyond the financials, right? Making sure that
yeah,
business
yeah,
is there.
and beyond, you can't mitigate risk if you only stick with big data.
Right. But that raises an interesting question because it's a challenge to balance as a bridge lender, especially because you have to move quickly, right?
Mm-hmm.
And gathering data, when it comes to especially local data for a quick bridge lender can be challenging, right? So how are you guys, I mean, do you literally have employees in every locale, or are you working with local brokers? Like, what are you doing to get that local level information?
I would rather have my people speaking with local brokers and management companies and municipal officials so they know what they're asking. You don't
outsource it. You have internal.
Right. So that's super important to us. We talk to a lot of people in a market as we're underwriting something.
And we talk about expansion. You guys, when you guys started, I mean, your headquarters are in Detroit. Were they always focused? Were they always in Detroit, or where did you guys start?
You started in Detroit.
Started in Michigan, and then as you guys expanded, like what was the process like when you're evaluating a new market? Because I mean, you guys are now in 40 states. I'm guessing it's going to continue to expand.
Yep.
When you enter a new market, what's the process look like for you guys?
Well, at this point, I run the deal team, and I've been to an awful lot of markets. So
you're flying around a lot.
So far too often, I'll be somewhere and I'll think, oh, my goodness, I'm in East Gish and I've been here before.
Right.
But a lot. It's not that difficult if we're asking the right questions of the right people to consider a new market. We get most of our deals through mortgage brokers. We are very protective of brokers. We think that they are very important to us. And so they'll bring us a deal, particularly if they have a geographic region that they are working. They're usually very helpful. And then we have a great, network of brokers or attorneys and accountants and others who can help us find the right people to talk to.
So the boots on the ground relationships are really helping you find the data sources. But you said something interesting earlier, is not just the real estate type kind of data sources or kind of boots on the ground type people. You're also talking to the municipal government agencies.
Right.
Local government. You're asked, and what are you talking to local government guys about? Like there's zoning.
We're trying to understand the economic development side, what's really coming. We also really want to understand supply that's coming. So, you were just speaking about industrial. There's so much industrial under development. You certainly would want to know what's coming. We were just working on a property recently in Pennsylvania, and in talking to the economic development folks, we learned about some highways that are planned that will dramatically affect positively, in that case, this particular building. It's going to open up a lot of new markets to it. And, if we hadn't been asking the questions, it wasn't something that was obvious material.
These types of analyses seem a little bit more for a conventional banker than a bridge lender. I mean, I don't see many of your colleagues taking this level of, I guess, data and this level of information at the local level. I mean, it's fascinating because what you're talking about reminds me of what loan officers used to do when I was a banker, right? The senior guys I used to work for would do that stuff. But I work for a bank, right? And so it was understandable. But my clients on the commercial bridge side, I don't hear them talking about this very often, this kind of level of information. What I mean, is this just basically just experience, your 30 years?
I think so. I think so. It's how, our job is to identify risks and mitigate them so that successful deals are done.
Sure.
And I think because of our experience and the dedication of the team, because I have really, really good people, we're able to still move quickly while we're being as thorough as it's the only way my partners and I know how to be.
Right. And are the majority of you guys all from like a banking background, a mortgage banking background, or some other folks?
No, we have lawyer, developer, note buyer, investment banker. I'm going through our list. We're all real estate industry, but varied.
But very different parts of the house, if you will. Okay.
Which is also helpful.
Understand how understand how to mitigate risk. They understand how risk works and how to mitigate.
Right.
That's fantastic. Well, I want to talk about the team now. I mean, the team. I mean, you guys are in you're 40 markets, but in offices and all over the country. I mean, how many employees now?
It's still a tight knit team. It's just in the low 20s. So it's
20s. Fantastic. I mean, I love lean teams, right? Lean and mean teams that are functional, right? And so, so in all the different offices, are these small satellite offices in some locales, like the LA office?
Some are, and then so the two that have the most people are Detroit and here.
Okay. And as you guys, you guys have multiple funds and you're a true balance sheet lender. We're not talking about mass securitizations or anything like that with you guys, but the need, to manage that many, and that type of institutional, or pension type funds or whatever type of investors you guys have, it's a pretty, heavy lift. But with 20 employees, seems like it's you have a lot of what do you call it? Swiss Army knives, right? A lot of multi-talented people.
We yes, and others who specialize, but yes, we're very serious about making sure that all the pieces fit together well. Obviously, I'm concentrating my efforts on transactions and asset management, and others of my partners are spending time on that, but spending a lot of time on investor relations and the various reporting requirements that we have, and on the company growth.
Right. And so when you guys, are you guys hiring right now? Everyone seems to be hiring in general. Are you guys hiring right now?
Mm-hmm.
When you guys are hiring, because you have such a tight knit team, what are you guys looking for? What is your company looking for? Like, what is the culture like at Bloomfield when you're hiring?
I think, and I'm always excited when people ask other people besides me what the culture is like. I think it's a very flat organization.
Okay.
I think, again, it's very communicative, and I think that it's a pretty fun, tight-knit group. We run it as a single company, not as a bunch of offices. So teams are put together across offices. The deal team has an open Zoom all day long that we all just hop in and out of.
It's just running all day long.
All day long.
And this is not a COVID product. This has been a thing.
No, it did start during COVID, but it's over a year old now, and we're just keeping it. It's really works very well when you have people in different offices.
Yeah,
so
I bet.
Say, hey, Matt, hey Mike, what about? And so you can just get a nice conversation going about any transaction or whatever is happening. And
it's a virtual meeting room you guys can just pop into at any time of the day.
Yep.
That's awesome.
Yep. So I think that the culture is really quite friendly and positive. It's very hardworking. A deal is a Bloomfield deal. They are not, some person's deal. We all, we all pitch in, and it's all very supportive.
Okay. I want to kind of dig into
Although
that.
I wonder, I should call over to one of the other people. Would you agree?
I hope so.
He says yes.
All right. Well, and that's interesting, right? Because you see a lot of commercial mortgage bankers and commercial, even on the bridge side, they kind of follow. You see a lot of them structured like banks, right? You see a lot of them follow the bank model. And tell me about your guys' like credit process. Do you have is it more of a team driven process, or is there a specific kind of like person who has to make the final credit decision? How does that look like?
No, there are 4 people on the investment committee. Our votes are unanimous. We have at least 2 calls a week on our pipeline, and again, a lot of communication about them. So by the time any transaction is going to investment committee, it has already been discussed. Everybody's really quite familiar
Right.
with it. But we do a very thorough investment memo, and there is a formal committee and committee approval.
And I like how you guys call it an investment, right? And that's important because you're investing, that you're putting your investors first.
Right. It's not loan committee, it's investment.
Right. It changes the kind of paradigm almost, like this is an investment, not, and that makes risk mitigation even more important, right? And so
we also underwrite any equity deal the same as any debt deal. There's not a difference.
The same process.
Same process.
Wow. And with the equity stuff and then the pref equity stuff, is it the same asset classes, or are there kind of more of a narrow framework in which you'll operate under?
It's generally the same asset classes, but there has to, be a compelling reason to take that additional step, and we have to have structuring that we're comfortable with.
Okay.
So, and I will say that like some of our equity, we have some industrial platforms that we don't really see much debt in that exact same space. They tend to be smaller bites that we build into a portfolio. So those individual assets would have been too small,
right,
to really do a lot of debt on.
And speaking of industrial, I mean, the word around town when it comes to commercial and industrial is cannabis. And, it's one of the primary drivers in our area, at least California, I'm sure in different markets across the country. What's Bloomfield's position on cannabis? Are you guys actively involved? Are you looking at it? Are you still considering it? We
are not in on cannabis.
Okay. And good, bad, or indifferent.
And fortunately, lots of people are, and we're able to steer transactions to them.
Okay. Has there been a particular, like, is it a risk issue? Is it a government issue of the objection?
That's a big part of it, and until very recently, the lack of title insurance and that.
Well, very recently, right? I mean, and it's a pilot program too. So
right. So that's among the reasons, but we're able to find a lot of other opportunities. So it's just not something that
balancing with e-commerce, I feel like there's plenty of opportunities on industrial. Most of it's being swallowed up by a lot of. I have a lot of friends who are in e-commerce, and they're all now renting space. It's amazing how much is out there.
Yeah, so. It's incredible. And, and in some markets, beer.
Oh, yeah. Oh, breweries, distilleries. They're now, you can have, there's a lot of the trend of microbreweries have really taken up a lot of the industrial space as well. Here in Southern California, so many breweries. I mean, it's a fascinating marketplace, that industrial asset class. I mean,
our recent industrial deals have included everything from heavy industrial in Houston to food-oriented, industrial in Ohio, to more e-commerce oriented in Pennsylvania, to so it's varied. Florida, it was just general warehouse distribution.
Right. And warehouse
closed in the past couple of months.
Right. And that raises another question about asset classes, and the counter to of industrial is retail. Right. And, how has retail treated you guys over the past few years? With COVID, that was one of the biggest pain points. I feel like retail, hospitality were one of the biggest pain points from COVID. How did you guys fare? Are you guys not in those asset classes as much?
We're in those asset classes. I think that there's a flight to quality. And so, we've fared okay because of that. We've been in some decent assets. Hospitality prices every night. So it's the first to be affected when the market is falling, and hopefully we, are seeing, or will continue to see. It seems like it's dipped a little bit. Recovery from COVID. Hopefully this Delta variant, again, who knows what the situation will be when this airs. But right now we are in the middle of that, and hopeful that it, that the recovery continues.
Okay.
Thanks.
And are you seeing like pockets of the country that are not as impacted by this stuff? And I've noticed, some clients of mine telling me like, we're fine where we are, but our counterparties over in LA seem to be suffering a lot. Like you guys are in 40 states. I mean, have you seen markets that haven't been?
It varies tremendously. And I mean, hospitality being a good example of, you can take a look at different types of submarkets. The drive to resort market came back first. While other markets, the convention markets are, still suffering pretty significantly, and it'll be interesting to see how comfortable people are about having huge gatherings. Seems to be, gaining momentum and dropping back, and then gaining momentum.
Right. Yeah. Exactly. Yeah. I mean, we plan events, and it's interesting to see how the hotels react, and how they respond and what they're going to do about it. Another question I want to ask you, Renee, is going to the idea we've been talking about, like beyond the balance sheet, almost beyond the data points, and you're looking at the operator. What are some intangibles that you're looking for when you're looking at a borrower? Because it sounds like, it's very uncommon for bridge lenders to underwrite the borrower. Right? It's very asset driven, right? But it sounds like you guys are not an asset driven lender in most regards. What are some intangibles you're looking for when you're evaluating a borrower?
It's important to us that the sponsorship, the borrower, and our interests are aligned as much as possible. So we want to make sure that they have some money in the game. We want to make sure that they either have a really good idea, experience, some combination thereof. We want to, again, this is about doing everything that we can to ensure that there's a successful business plan, because a successful business plan means a takeout loan, because we are bridge lenders. We are not here forever. Right. You don't want us here forever. It's not good for your project. So we want to make sure that we are understanding what's going to be done, how much it's going to cost, that there's enough money, that we have structured it, to make sure that all falls into place, and that, therefore we can help usher the loan through to the next takeout.
Right. But from my perspective, right, it's kind of interesting, back to the whole idea of like, that's normally what bankers do. And like, there's time there, right? The bankers are notoriously slow, right? But as a bridge lender, it's quick. What's your normal close period look like? How fast do you guys usually
4 weeks?
4 weeks. So you're doing all this in 3 weeks then, really?
Pretty much.
And is that just kind of you guys have built the systems and processes for this, or?
And we don't sleep.
You live on the phone, right?
That's right. Phone on the road.
Well, I get that. I mean, it's dedication to the process and to the business. I mean, that raises another question. Majority of your team members, how long have stickiness to be able to do this? You need people that have been with the company for some time, right?
Right.
You've been with the company since 2017.
And we have some people who have recently joined us who are terrific, and we have, I'd say the person with whom who does a lot of the underwriting, that I was just talking to, has been with us for 7 years. Generally a long time for the people on the underwriting team.
Very cool. Well, I want to get your thoughts on kind of like where we're headed, right? Because like you mentioned, right, the hospitality markets with this Delta thing going on, like it's very unpredictable, and multifamily was something that you didn't see it. You thought it'd be worse than it really was, and all this other stuff. Where we're going, right? And there's an interesting question that's coming up a lot is the shift into residential, right? Even in commercial real estate, I've been talking to developer clients of mine who've been doing a lot of conversions, right, and switching to a residential strategy, and getting away. They used to do a lot of retail, industrial, and doing a lot of this kind of conversion work. Where do you see things going? Because that's just input from them. Right. Where do you guys see things going when it comes to the bridge space for the market?
Yeah, again, we try to let every market tell us. There are
Yeah,
places where we would be thrilled to be, looking at apartments, and other places, well, most anywhere you'd be thrilled to be looking at apartments.
sure.
Um, I mean, think retail, the jury is out. I think that we're a lot more interested in grocery anchored than we are in some of the other types. You go back to what are people going to use? Does it make sense to
Right.
us? And there are new tools that that we all have available to us to that are kind of fun to start to use to hone some of those thoughts. We used to all use like Esri data. Now there's Placer also, where you want to see what the traffic actually is. Um, it's just fascinating to sort of watch how the industry changes over time.
Hmm.
But so we're careful
Hmm.
when it comes to things like office and retail. Others, hospitality depends on where you are, what the price point is. Is it, generally speaking, a lot of hospitality should be in a discount market right now. Things are getting so highly priced that if somebody's coming to us and they want a new loan, we want to understand what the basis really is.
Hmm.
Who's taking a haircut? Are they getting something? Is this a DPO that's being financed as opposed to just more dollars going after
Right.
old dollars? That sort of thing. Um, so I guess one of the things that I've learned over the years is while it's we develop vision, we see parts of the country that we really like, we see some property types that we really like, but you try not to be so steadfast in your position that you don't have an open mind to the data that is developing.
Right. And let those data points inform you as opposed to, kind of following the trends, if you will, right? You're being informed by local data, right? Not just, we talked about earlier, the idea of you say you're tracking traffic. What kind of traffic? Like actual car traffic, like driving by traffic, or like?
Oh, sorry. One of the tools that we used recently is something called Placer AI, which is tracking phone, tracking actual traffic into a particular store or shopping center based on cell phone data.
Like foot traffic using cell phone. Really? Well, there you go. Right. And that'll inform you the usefulness of, that right away will tell you whether retail is worth it.
Right. It was really interesting. You could watch, month by month during COVID.
Right.
What was happening.
Right.
Back up.
Do you see your sponsors kind of following suit with this kind of stuff? Because like I'm still seeing people building like retail centers. Like it's fascinating. Like, why is this stuff being built right now?
Oh, right. And we still see some of it, but a lot depends on, if you are a sponsor who has a relationship with one of the major tenants and they're signing a 10, 15-year lease and saying, please go build on that corner, then that's different than if I build it, they will come.
True. Right.
Very different.
And then again, to the same point you made earlier, a lot of them are grocery anchors, so it makes more sense.
Right. So, but you do have to be careful as you're looking at older properties that have old credit tenants in them, or old, high rates, and again, back to the municipality and really thinking about how growth has gone in that community. How likely is the tenant to sign again, to re-sign and stay at a high rate, or is that old $32 a foot drugstore going to be vacated and you're only going to get $14 a foot?
Right. We're starting to see parts of Southern California become ghost towns, mostly in LA County, and that kind of informs the trend. Like you see old former drugstores, fast food chains, things that would normally do well, but with today's current climate, it's not as attractive. And that raises another question for you: is office. And this has been kind of a debated point. And a lot of it's non-real estate conditions. It's really more work conditions. Where do you land with like the whole, a lot of lenders have taken a position based off of like, oh, work from home is now a thing. But then other people say, well, no one's working from home where we are, right? Like, how has that informed you guys, the whole work from home trend, post, I guess we're still in COVID, like with the transition?
We know a lot of people who work from home, or a lot of people who are returning to a hybrid model, where they'll be in part of the time and out.
Right.
And we're seeing that in lots and lots of markets. And I think that the question, and I don't have an answer for it yet, and so we're still watching, is, what does that do to the cost of productivity?
Right.
How much is your space worth if it is now supporting only half as many people, or is it 2/3 as many people, or is it 3/4? And I don't think we all know that yet. So I think
we're still figuring it out.
We're still figuring it out. And, I had high hopes that this fall would be sort of a point of reckoning on it, especially as kids went back to school and, parents could go, to work in whatever the long-term setup was going to be. Now,
right.
With, I'm not sure if everybody's going back to school.
Yeah, I don't think schools are fully reopened yet, but the question mark as to these multinational companies with offices across the world, right? It's like, are they bringing their employees back to work? The big employers in the country. I don't necessarily know.
They were planning to,
right?
I think some of them are wondering. A lot of them were planning on September.
Good to know. It's interesting because with small businesses, you see a lot of people back in the office, and that reflects the pricing. But with office space, it's always, and there's a lot of office space. Here in Irvine, California, there's office towers being built still to this day, and it makes me wonder, like, what are they going to do with all this stuff?
But then there's a flight to quality, right? So then
right.
The question really is, what happens to the old office towers? And there was some of that we were seeing on the distress side a year ago, in some of the corridor and some of those areas. So it'll be interesting to see. The book is not fully written on that.
Fair enough. All right. Are there other pocket industries that you guys are excited about? Like, I guess markets, or I guess asset classes and markets that you're really excited about?
I think that there are a lot of really interesting types. Some of the life sciences, manufactured housing, I think is a great one, and one that we spend a fair amount of time in. I think that industrial has so many subcategories.
They do. Yeah, it does.
There are parts of it, the last mile, cold storage, small cold, I think are really, really interesting spaces. I think that some of the creative reuses of big boxes, I think, are fascinating. Where the shared kitchen is going. I think that
we have a whole park in Newport Beach dedicated to that. It's just a series of kitchens being used by various caterers, and they do fantastic.
Yep,
it's industrial. Yeah,
so we've lent on properties like that. There are also the ghost kitchens, which is sort of a cousin. So it's fascinating to see what's coming, and then again to just try to figure out therefore what opportunity is there, and how do you balance that with upside and downside risk.
And I guess looking forward now, and commercial bridge has really taken a large piece of what 15, 20 years of loans that my colleagues at the bank would have done, my father would have done when he was a banker. And it's interesting to see the role of private independent lenders on the bridge side. And, as Bloomfield continues to grow, where do you guys see, the role of private, independent lenders, non-agency in the world of, I guess, finance when it comes to commercial real estate? Because the rules are ever evolving, right? What used to be just bridge is now also pref and mezz and also equity, also doing construction, also doing stuff that, they wouldn't normally do because banks have tightened and done what they've done. What are your thoughts on that?
I think that you put it well. I mean, we started as, straight first mortgage bridge. That is where we will spend most of our time and most of our treasure. But finding other opportunities and making sure that we're getting the yield that we desire will, go up the capital stack, up and down the capital stack a bit. I think that the role of bridge lenders is going to continue because I don't think the banks are going to get any broader.
And they're not coming in, right? They're not trying to compete.
No, they can take us out.
But they're not trying to compete. You're not seeing like banks, like smaller banks, trying to come in and compete with you.
No.
Okay.
No. But but a lot of the people or the opportunities that we're seeing aren't ready for a bank yet. So we may be helping somebody to get to a bank takeout. So they have to be careful. The banks have to be careful about the risks that they're taking and the ratios that they're having to adhere to.
Oh, yeah.
So they often are a takeout for us.
Okay, that's good. I mean, I'm excited about the continued evolution for commercial because when I started here at Tarasi, I come from a family of bankers, and when I saw commercial take off, I was just shocked. I'm like, wow, what are they? Wow. I mean, because it was amazing to me because those are the ones I would have done at the bank. When I was a banker or loan officer.
You would have banked or you wouldn't have banked?
I would have. When I was a loan officer, this is pre all of the, this is 2002, right? 2001, 2002, like this is pre-crisis. And these are the ones that we would have done. And then since then, the banks have changed their position on everything, right? And so, and I talked to my dad about this a lot. He was a loan officer, he was a banker for 30 years, and he's like, you wouldn't believe what they say yes to right now. It's this tiny sliver of what we used to do 20 years ago, and it continues to get smaller and smaller. And it's an interesting dynamic right now for opportunity for you guys, but dynamic because the funny part is there's more and more banks being opened. That's to me. That's
as an industry, it's a much smaller industry. There are only whatever it is, 5,000 banks now. I'll have that number wrong, so I'm sure somebody will fact check it. But it's far, far fewer than there were 10 years ago.
Interesting.
10 years ago.
Okay.
So it is interesting. And I think another area for us that we see as an opportunity, maybe this is going back to an old bank mentality as well, is we like repeat business, which is how banks used to work as well. You wanted a relationship. So, nothing makes us happier than somebody coming back for their second, third, fourth loan, even if it's only going to be a year or 2 years. And then, we'll all be moving on to the next opportunities.
But the nice part about the bridge space is become standardized from that standpoint. Like if you're a developer or builder, you're not going to a bank to start. And right now, the move is to go to a bridge lender now. It's which
you might need, or you might need, a little bit of mezz or pref to top
that too.
Top off your equity need.
That too, yeah. Well, very good. All right. Well, I like to close with one final question for you, and we always ask on the podcast is bullish or bearish looking into the next two years, 22 and 23. We're going into 22. Man.
Okay.
22, 23. So from someone who's a good person at risk, I always want to.
So I live bearish. That's just me.
Right.
So, but I think that I think there's so much money right now chasing the markets. So for some people, they say that's great. There's so much money chasing the markets. That's bullish. For me, there's so much money chasing the markets that I am a little bit more conservative to make sure that we're getting good deals. So I think that we're going to be very busy. I think that we are going to have a lot of success with a lot of transactions, but we will continue to keep our radar up and make sure they're safe.
So cautiously.
I'm cautiously bullish.
Okay. Well, that's what it's all about, right? I mean, from a person who understands risk, right? Cautiously bullish is a pretty common.
That's pretty good for me. That's pretty good for me.
Yeah, and you're right. I mean, I think that there's an indecent amount of capital in this space right now, and we'll see what happens. I mean, it's causing excess risk being taken, and I think we'll see some adjustments. I agree with you.
Right, and bearing in mind that we also are positioned so that there is distress.
Right.
We're happy to jump on it. So for us, that's another reason to, we have a lot of debt buying experience.
So distress is an opportunity for you guys. Definitely. Well, that's a good place to close the show out, this episode out. Renee, thank you so much for joining us on the show. It's been a fun one, and we rarely got to get to talk CRE on the show. So I love the fact that we did. I got to turn my old banker hat on, and I really appreciate the time. And
you can do a little underwriting on the side if you want.
I haven't written on the loan file in about 20 years, but hopefully we'll be able to connect soon in person, and we'll do another one of these. And this is all for Lender Lounge for this episode with Bloomfield Capital. Thank you very much for listening in. Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.